In this video, I want to talk about Fair Isaac, FICO, because a lot of things have happened, a lot of things have changed, and you have a lot of people commenting on the situation, a lot of noise about FICO. So what is really happening right now? Seems like the business is going to increase the growth. Seems like the business is going to change their strategy. They are literally fighting their partners right now. So what is happening? In this long video, I suppose, I have a lot of things to share with you. You can take a cup of coffee, cup of tea. I have a bottle of water, and I will walk you through everything you need to know about Fair Isaac before making an informed decision. So I will show you some tables, I will show you some margins, some charts. We'll talk about the valuation. I will show you some internal documents from Jefferies. We'll do some estimations of the new pricing policy. I mean, you will have a lot of value. I think you will like it a lot. And we can start now. I don't know how long this video will be, but yeah, it will be pretty fun. If you are new to this YouTube channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And full disclosure, I have been following Fair Isaac for a while now. I bought the stock in 2022 when the stock was reasonably priced, when you had the price to free cash flow of 25, okay? And I made a lot of money on this one, and I sold on the way up. Now the stock is going down again. You have a few complaints about FICO being a monopoly, doing some price gouging from the US government. You have some competitors saying now you will have a different score, the Vantage score, that will take up more market share. At the end of the day, the valuation reached in late 2024 was very high. Let me show you what I mean. If you look at the ratios here, ratios change price to free cash flow, basically the stock is dropping because the stock was expensive. Don't think too much about valuation, guys. You had a price to free cash flow of 90 in November 2024. Trees don't go to the sky. Trees don't grow to the sky. At some point, you need to be reasonable with the valuation, and it has gotten out of hand here. So, now that you know why the stock is dropping, now that you know that I was a shareholder, I want to be a shareholder again, because I have thought about my investment strategy in the last couple of weeks, and basically I want to avoid serial acquirers, and I want to focus on companies that are in a niche industry, in a niche product, niche service with a very wide moat, and they are just squeezing all the juice of their industry. And Fair Isaac is in this lucky position. They don't like M&As. They don't like to do to make stupid acquisitions. They don't like dividends. They just want to do buybacks, create a lot of cash flows, and continue to do buybacks to improve earnings per share, free cash flow per share. And in the very long term, stock prices follow earnings per share. So their biggest mindset is to focus on earnings per share growth. That will eventually move the stock price up. So it's a very simple business model to understand. In case you don't know this stock, if you don't know this business, Fair Isaac, it's an old company. I mean, a couple of decades old, and it's a company behind the FICO score. They are responsible for more than 90% of the score originations in the US. If you want to have a mortgage, if you want to have a new house, you want a new loan, people will ask you for your FICO score in the US. You have a score, a 3-digit score, and depending on your score, like in China, if you have a low score, you will have a very high interest rate. You have a high expensive debt. And if you have a high score, you are more wealthy, maybe you own more assets, maybe you have paid all your loans on time before. Well, if you have a high score, banks will be much more easy when it comes to giving you the loan at a very good rate, okay? So it's in the backbone of the US economy. It's about the US consumer. And now as interest rates are going down, well, it's very likely that more people will take on more debt. I follow the mortgage market. It was going up massively during COVID. And then went down massively and seems like it is picking up again a little bit, like we are bottoming. Equifax just reported earnings. The mortgage market is a little bit flat here, but now as the interest rates are going down, I am expecting more loans to be issued, more mortgage to be issued, so more market for Fair Isaac. Okay, so Fair Isaac, the company behind the FICO score, just announced a business model change that the market is barely noticing. The stock was up on the news 20% in one day. All the shareholders were very happy and they said, yeah, I told you so. And now we are back to where we were before the announcement. So the market has not picked up. Maybe they have not understood what is happening. It's very new, it's very recent, and this is why you clicked on this video. It's not just a price increase because it's a complete change in business model. It's a complete rewiring of how the company captures value from its credit scores. If you understand what's changing, you will see why earnings could jump 20 to 30% within the next 2 years and why I will be waiting for a specific price to buy. In this video, I will tell you my buy price, the updated buy price given the new change. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So, a little bit of background about the business so you can understand the before and the after, okay? So the background, FICO owns the US credit scoring system. Over 90% of all loans in the country depend on a FICO score. Historically, FICO sold those scores through the 3 credit bureaus, Equifax, Experian, and TransUnion. FICO could charge roughly $5 per score, but most of the profit went to those bureaus because they own the customer relationships with lenders. Yeah, it was like a royalty business. FICO was a royalty business, and in the past, the score was $1. And then something changed. For 25 years, FICO didn't have the power to change their prices because of regulatory reasons. And then in 2018, something changed. Look at this. If you look at the operating margins of this business for the past 25 years, pretty stable, right? 25%, 25%, 25, 20, 25%. And then in 2018, new rules, new regulation, you can have pricing power. You can change the prices of the score. So the margins went from 20% to 25%, to 30%, to 35%, to 40%, to now 45%. And I'm expecting that now with this new change, the growth rate, the improvement in operating margins will continue to accelerate, to go up. It's pure profit. It's a pure profit change, pure incremental margins for FICO. And I think the move that we are just seeing right now is very new, very, very likely to improve the profitability of FICO by a lot in the future. Okay, so just a little bit of context. For 25 years, they have not changed their prices for the FICO scores. And now since 2018, they increased the prices from $1 to $2 per score, 3, 4, 5. So now they are at $5 per score. So newspapers, people on CNBC say it's price gouging because you have increases of more than 400%, 500% to some regions. Yes, I mean, you go from 1 to 2 to 5, it's not a big deal at all. Because on average, the price of having a new loan, if you want to buy a house, you need hundreds of thousands of dollars, if not more. On average, the price is $6,000. For an individual, for me, if I want to buy a new house, $6,000. Will it make any difference if the price for a score is $1, $5, $20, $50? I don't mind at all. I'm paying $6,000 already. So no big change whatsoever, which gives FICO a lot of potential to continue to increase their prices. Basically, you go from 5 to 10 to 15, people will not care at all. Okay, so the result of this with the royalty business model was predictable margins, improving margins, but limited growth and no control over end pricing. In 2026, that structure gets flipped upside down Let me give you a little bit of context here. You had two scores in the US. You had the FICO score, the big leader, and the Vantage score that has been here for 20 years, was implemented in 2004, 2006, like a long time ago. But it was never a very even battle. Nobody uses the Vantage score. Everybody knows the FICO score. They've got the reputation. Even though you have some people that want the Vantage score, so they pay for the Vantage score, they also pay for the FICO just to be secured about the quality of the relationship, etc. So you have a competitor called the Vantage score, and the three credit bureaus are responsible for this Vantage score. And they've been fighting over market share, same thing in 2014, 15. They don't get the approval a little bit. They say that the FICO scores are doing some price gouging. So at the same time, they have no regulatory measures. And now, very recently, they said that the regulatory regime for Vantage score improved. So maybe the Vantage score will get more market share, so more than 10%. And at the same time, the bureaus, Equifax, Experian, TransUnion are all saying, yeah, the Vantage score will be free for some people. The cost will be very low. So FICO, leader, increasing their prices. Vantage score, losers, lowering their prices. You spot a pattern here. Some followers of my profile, some subscribers, know that I say this very often. Winners keep on winning. FICO is a winner, and they will continue to win in the future. And this small competition with the Vantage score will not change anything, because in the latest updates about Vantage score will be free, available, etc. We have the regulatory regime now. If you look at the latest earnings, the latest earnings calls transcripts from FICO, a Wall Street analyst asked, do you see a pattern? Do you see a change now that you have this new regulation and the competition from Vantage score? And the CEO of FICO said, no, absolutely zero. Zero change at all. We have the best scores. We have the best reputation. We have the best partnerships with the best banks. We see absolutely no change. So it's like a small dog that is barking a lot, but actually they never bite. So this is exactly how I see the situation. FICO is here, the leader, and they will continue to be the leader. And because they are fighting, well, FICO has had to fight back. And the fight back was a change in structure. They announced something big that will get implemented in 2026. This is the big change, the direct-to-reseller model. Starting in 2026, FICO, Fair Isaac, will begin selling directly through resellers such as CoreLogic and Meridian Link instead of the traditional credit bureaus. These resellers already serve most mortgage originators and lenders, so the transition is operationally simple. It's a very simple tweak in the business model, but it will create immense incremental margins for FICO. The new pricing doubles from around $5 per score to roughly $10 per score. Literally, FICO wants to increase, to double their prices, and they will skip the bureaus. So it's a double negative for the bureaus. For lenders, the total cost of pulling credit data barely changes, but FICO now keeps most of all the economics. Yeah, you don't have to share the profits with the bureaus if you don't work with the bureaus. So it's pure profit for FICO. Same product, same workflow, but FICO finally captures the full margin. FICO has the data. They have an analytics part also. They have the data. They've been collecting all these scores. They have the best algorithms. They know how to do this themselves. So maybe they can work this out. It's not 100% that they will implement this. It's not 100%. They will succeed. Maybe the US administration will change something. Maybe the competitive landscape will change. Maybe you will have some barriers. Maybe they will fight back. So there is a probability that FICO fails. But if they succeed, it will be quite huge. So now I want to talk about the Jefferies document. This is this table that I have here to show you. You can take a screenshot of this one if you want. Normally it should work properly. You can take a screenshot of this so you can watch this at home, and it gives you several options, option A, B, C, of the before and the after of the situation if FICO succeeds in implementing this new pricing policy with the different prices, different costs for each partners. Okay, now here is what it shows. The Jefferies research slide breaks down FICO's 2026 pricing options. On the left side, you see the old structure, around $18 total per loan file, with FICO receiving only a small portion. Let me show you what I mean. If I zoom in, if I zoom in too much, you don't see the bottom of the document. So at the first column, you have 2025 current pricing through the bureaus, like what is happening right now. You have the score fee, etc. You have the Vantage score fee here. You have the reseller merge fee of $20. So the total credit report and score cost is $75. Okay. So now you have the margins depending on Equifax, the reseller, and FICO, who has the revenue over there. Okay. It's a split between 3 partners. On the right side of the document, Jefferies models the new direct and reseller scenarios. Total cost rises slightly to around $30, but FICO's share of that jumps dramatically. It shows FICO's revenue per mortgage file roughly doubling and its gross margin approaching 100% on that incremental position. Okay, now let me explain a little bit, because I'm guessing this is the first time you see this chart. So let me explain a little bit how everything works. You have 3 scenarios, A, B, C, and you have the Vantage score 4 also. That's a 4th scenario, but this is not that important. Option A, scenario A, FICO option A, you keep the $5 score and the close fee through reseller. Okay, the only thing that changes is the loan close success fee that will be implemented here. Nothing else changes that much. A few dollars term here and there, but nothing big. In terms of margins, nothing really massive about the changes. This is a scenario that can happen. For the option B right now, you have the $10 score instead of a $5 score, and you go directly to the reseller. You don't go through the bureaus. If you double the price of a score, you double the revenue. Here, look at this. You go from 17 to 33. So FICO can double their revenue coming from the score segment. You scroll down the reseller, they have same thing, $20, and you have total credit report and score cost of a little bit more. You go from $75 to $94. That's an increase of 26%. So instead of going and working with the bureaus, if you go directly through the resellers, you increase the revenue for FICO of 26%. This is how I see the situation. Maybe I'm wrong on this one, but this is how I see the situation. And then, this is the revenues. You go from 18 to 33. Incremental margins of 100%. This is why I say the margins, the operating margins, there is a scenario where they skyrocket now. Okay, nothing changes for Equifax here. Well, it will be a minus for Equifax. And for the reseller, nothing changes much. For the third scenario, FICO option C, $10 per score, but you go through the bureaus, you have the same amount of increase in revenue for FICO. You will increase your revenue. And you have total cost for the borrower that is the same, $94. The only difference here, if you work through the bureaus, is this: the revenues of $23 and the gross profit of $13. Basically, the margins are changing for Equifax. This video is not about Equifax. I can make another video about this one. But basically, what can be the most profitable for FICO is to just avoid working with the bureaus. It will be very complex to do it, but now FICO has announced 2 things. Either you cut the bureaus completely, or second scenario, you increase your prices. Anyway, in every scenario, this is a negative for the bureaus. And in every scenario, that is a positive for FICO. So whether, maybe I'm not understanding this slide very well. Maybe I said something wrong. In this case, the comment sections are for this. But from what I understand, in the three scenarios that are shared here in this table, in every scenario, FICO is winning. In every scenario, it's either neutral or negative for Equifax. And this is only happening, this change is only happening for the mortgage segment. FICO is not only in the mortgage segment. I'm talking about this later, I think. You have only a portion of the business that will be changed. It's not the whole business of FICO that will be changing, no? Right? It's only, 20 to 30% of the business model that is changing? I would say something like this. But it's a small incremental change. For example, if they implement this pricing policy for, say, 30% of the business of FICO, and it works, well, they can implement this business model change for other parts of FICO and most of the parts of FICO. It can happen. It can happen. By the way, nobody is complaining that the scores will go from $5 to $10. Nothing, you have no clear backlash. Even Bill Pulte from the government has not said anything very big. Bill Pulte is the guy that tweets from the US administration, and every time he tweets bad things about FICO, FICO drops 10%. Apparently, nothing really big here. Another backlash that we just had, by the way, is FICO dropped 10% in one day when the bureaus, Equifax, etc., said that the Vantage score, so the inferior score, was going to be free. Okay, so you have a new kind of score that will be free. But can you really trust the Vantage score? I mean, at some point, your service is inferior. You have to admit it. The Vantage score has been here for 20 years and no traction whatsoever. It's not a matter of price. It's a matter of efficiency. You don't want to fail when you evaluate a client that wants a loan. You don't want to make a mistake that will cost you a lot of capital. So you want to go to the safer option, and the FICO scores are the safest options because they have the best algorithms and you can trust the data. Maybe at some point you will have a gap of prices that will be so large, FICO scores will be like $50 and Vantage score 0. So maybe you will have a change because of millions of volumes, but I don't see this happening right now actually. Let me continue. Yeah, I hope it was clear because maybe I don't understand 100% of this table, but I still wanted to share it with you. So maybe I made some mistakes, but you get my point. You have three scenarios, very bullish for FICO from Jefferies. Okay, gross margins 100%, incremental margins. This document is important because it confirms that Jefferies, one of the few analysts following FICO closely, that's true, expects a step function increase in profitability once the model goes live. It also highlights how the credit bureaus lose a meaningful revenue stream, which could push them to retaliate, but they have very limited leverage because FICO scores is embedded in US lending regulations. Absolutely. I couldn't agree more here. This is a conclusion I share with Jefferies. This move, despite everything they want to say from the bureaus, etc., this is a net negative to the bureaus and a net positive to FICO. And this is the beginning of the fight. So I don't know how the battle will evolve in the future. The Jefferies slide basically quantifies what investors have missed. FICO is about to earn twice as much per transaction without needing any new customers or volume growth. It's a pure pricing power converting directly into profits. Margins will if they succeed, margins will skyrocket. I can show you something that you will like about the segments of FICO. By the way, I'm using this website, Stock Unlock, here, and this website, Fiscal AI. You have both links in my description to have affiliate links, discount codes. Literally, you use my links, it's cheaper for you. And you can try this website for 2 weeks for free, I think, without putting your credit card. So in case you want to manipulate this data the same way I do, it's free for 2 weeks without your credit card. And after this, it will get cheaper if you use my links. So feel free to use my links. I want to show you how important the score segment is. Total score, comment size. This one on an annual basis. Very good. Okay, on this chart, you see a blue line. This blue line is how much of the revenue for FICO is due to the score segment. So you see in 2014, the 23% of the revenue was coming from the score segment. And then in 2017, 27% of the revenue was coming from the score segment. What has happened in 2018? I just told you, you just unlocked the pricing power for Fair Isaac. So since 2018, this trend has accelerated a lot. The score segment represented 30% of the revenue, 40% of the revenue, 50% of the revenue, and it will soon, I am 100% sure of this, it will reach 60% of the revenue. It already did actually. 60% of the revenue, and I'm forecasting it will get bigger in the future. 70% of the revenue will be generated by one segment that was rather small in the past, because that's what the beauty of Fair Isaac is. And in terms of comment size, what is really funny is we said the score segment represented 60% of the revenues, total revenues. But in terms of profitability, the score segment represents 108% of the EBIT, the operating income. So the whole profitability of Fair Isaac revolves around the score. We don't care about the other segment, the analytics segment. We don't care. It is not growing. It's not that profitable. It's okay. What is the key driver for growth and earnings per share growth in the future for FICO is only the score segment. And only this. This is the only thing that matters. And now we are beginning to shift the business model. So you have to be aware of what is happening. Okay. The next moment you will have more data to update your models will be during the next earnings call. During the next earnings report for FICO, they will maybe share a little bit more data about this new pricing model, how it works. You will have Wall Street analysts that will ask questions to the CEO, exactly how they see the things. Maybe they will back down, maybe they will double down, and they will say they expect much more price gouging. Maybe everything is possible, anything is possible. So we will see for the next earnings call what is happening. Let me continue. Why it matters. The score segments represent 55% of total revenue. The mortgage position makes up roughly half of that. So, we just said it's not 55%, it's 60%. Anyway, the mortgage section inside the score section represents half. This is the most important one, and this is where the scores are the most expensive, like $5. For other segments, different kind of scores you can get: credit card FICO scores, auto, like you want a new car, auto FICO scores. The price of a score is $1.90, $1.50, and you don't have such pricing power because it's not that regulated. You have more competition. Anyway, this is not the point of this video. For the mortgage segment inside the score segment, it's 50% of the revenue, and it's where most of the pricing power comes from. The mortgage portion makes up roughly half of that, meaning around 30% of total company revenue will shift to this new structure. Because the cost to deliver each score is close to zero, I mean, look at the gross margins for this business. You have gross margins of 82%. You don't have costs. And if you want to know the margins, the EBIT margins for the score segment. Oh, it got deleted. Anyway, let me create the custom metric so you don't have to do this at home. I know you just like to enjoy the show, so score. I want to create my own custom metric. I believe score EBIT margin percentage. Very few people on YouTube are showing you how to create these custom metrics. Let me create it live for you. I want to have the score operating income divided by the score revenue. Here we go. And now you will have the profitability only for the score segment, not the analytics segment that we don't care about, not the software segment, only analytics. What you can see here, if I put on an annual basis, you see that for the past decade, the margins went up basically from 75 to 80 to 85 to 88% EBIT margin. Can you name 10 businesses that have an EBIT margin, operating margin of 88%? Very few businesses have this. And we are in almost a monopoly. They have infinite pricing power so far. They don't have competitors. Competitors are kind of fighting, but it doesn't work. And FICO has ultimate power over their market. They have margins of 88%. And now with this new model, margins will cross 90%. I'm pretty confident in saying this. You will have margins of 90% one day or the other for the score segment. Okay. So, because the cost to deliver each score is close to zero, as I just showed you, immense margins, nearly all the price increase flows straight to the bottom line. This effectively turns FICO into a SaaS style business with recurring high margin economics and direct customer ownership. Okay, it shifts from being a royalty business model to being a SaaS business model. Is it a good thing, bad thing? Time will tell. It's too early to say if it will work out, but now this is how the situation is. So, in terms of timeline, we are in 2025, so it will not be implemented this year. So, 2025, old model. Earnings stay mostly stable, nothing changes. For 2026, new pricing launches. This is where you will have a start of a change. Partial impact as new mortgage originations use the direct model. Yeah, and I'm guessing people sometimes will choose the option B and then option C, and then they will hesitate. You will have fights with the bureaus. 2026 will be messy, in my opinion. And then once the model is tested out and appreciated by the market, and then people realize the value, in 2027, you will have a full rollout across mortgage scoring, which means the earnings inflation becomes visible in reported numbers. And then from now on, you will have the potential to apply this pricing model to the other FICO scores I just told you about. The auto FICO score, consumer FICO score, personal loan scoring. Okay? The key takeaway is next year will be transition year. You test it out. Maybe they fail, maybe not. And if they succeed, 2027 will be huge. Results will explode higher. What is the probability that they succeed? I mean, you choose. Financial implications. Now, if you look at the analyst estimates, I'm on Fiscalia right now. You can choose to see on estimates, revenue. This is what Wall Street is expecting for the business model. For the revenue in the future, Wall Street expects a growth rate of 15%. Earnings per share, people expect earnings per share to grow 25%. Well, maybe you have to adjust this. Analyst estimates for 2026 still assume the old $5 per score pricing, so consensus numbers understate the future earnings. Because this is very recent, most Wall Street analysts have not updated their models. I have read all the press releases, all the equity papers on this one. Sometimes they say, yeah, we are not sure. Sometimes they say, we expect 20% more earnings per share growth. Okay, fair enough. You don't have a clear consensus here. They probably understate the future earnings that this new model will bring. Adjusting for the new pricing, earnings per share could rise 10, 15%, or even 20% actually, in 2026, and around 20, 30% by 2027. More than what was actually in line and expected, right? Once the model is fully deployed. And free cash flow is nearly identical to earnings because, FICO is an asset-light business model. So, at today's price, around $1,600, as you can see here, today, this is the price, a little bit less than $1,600. FICO trades at around 43 to 45 forward free cash flow. Let me show you proof of what I say. On Fiscal AI, if you go to ratios, forward, price to free cash flow, is it updated? It's not updated. Okay, sometimes it happens. Look at this. The latest data we have for the forward price to free cash flow, is October 7th. We are not October 7th. The price has dropped. So the price has dropped to where it was before the jump. So actually, we can guesstimate that it's as if the jump never happened because we are back to these levels. So here we see 43 forward price to free cash flow. Okay, this is the ratio that is shown here. So you have a forward price to free cash flow of 43, 45 based on old estimates, but closer to 34, 35 times once you include the upcoming direct-to-reseller model. So for a company compounding earnings at 20% annually, almost for sure, with this level of predictability, what is the fair multiple? A fair multiple could be 30, 35 times the free cash flow, which means the stock is currently fairly valued, maybe slightly ahead of fundamentals, maybe not so cheap, but not so expensive, because now earnings will go up meaningfully. So my ideal entry range remains $1,200, $1,300, which would imply about 27 to 30 times next year free cash flow. Yeah, in the past I had a buy price that was a little bit lower, and now I'm telling you the updated buy price for me is $1,300. So it was there a couple of months ago actually, before the update. So before the update, I had a buy price that was lower, like $1,100. But now that you have this potential incremental pure profit gains, I have updated my buy price to $1,300. And it's almost certain that I will buy at this level if everything stays the same. So that's an attractive multiple for business of this quality and durability. But now if you consider that we are at a reasonable valuation, maybe it's a good time to buy now. I mean, you see this graph, you have this huge jump and back down. So as if nothing happened. Maybe now is a good time to buy. We are reaching fair value and the business will improve. So you will maybe have positive surprises in the future. Okay? So it's not as if you have a calm, relaxing future ahead of FICO. No, it's very likely that you will have positive surprises in earnings. They will maybe get more aggressive. That will be maybe a reason for a regulatory measures to make them slow down. But for the moment, I see more aggressiveness. Key takeaways. This is a structural transformation, not a temporary price adjustment. Yes, the market still models FICO as if nothing is changing, and the stock price has dropped as if nothing has changed, which creates a time-lagged opportunity once the new pricing kicks in. FICO's regulatory moat is massive. Fannie Mae and Freddie Mac still mandates FICO scores for all conforming mortgages. The credit bureaus lose leverage. Equifax, they just reported earnings a couple of hours ago as I'm recording this video. Basically, the business is okay, but they are mostly complaining and they know they are in a losing battle here. So the credit bureaus lose leverage while FICO gains control of pricing, distribution, and margins. The company is evolving from a score provider into a data-driven risk decision software platform. The main risks now, you have risks, obviously, everything is about risk reward. Slower lender adoption, potential political backlash, this is the big one actually. If mortgage costs rise, you will have maybe many tweets from Bill Pulte from the US administration. Maybe the stock will drop 20% in one day because of one tweet. That's life. And friction with the bureaus. What if you have a real fight, like a painful battle to watch between FICO and the bureaus? Maybe it will be a big clash. Maybe you will see some disruption in the industry, or maybe not. But you have to take into account all the potential risks that can come. And another risk that I can add to this is valuation. Valuation can continue to go down actually. I mean, when I was buying FICO back in the days, you had a forward price to free cash flow of 25 in 2022. So it can happen again. It's not because the business model is getting better that the valuation can't get lower. Sometimes you have crazy situations in the market. I remember when I analyzed deeply FICO in 2021, you had the price to free cash flow of 35. I said, yeah, pretty good for a quality business. And then it dropped to 30. I said, oh, wow, this is getting interesting here. And then it dropped to 21. And I bought here in late 2021, price to free cash flow of 25 or something like this, sweet spot. And it continued to go down. And the bottom was a price to free cash flow, not forward, trailing price to free cash flow of 20. Which means the forward price to free cash flow at the time was quite low. And then you shoot to the sky, it reversed back from a price to free cash flow of 20 to 90. So you can get some crazy swings, which means another risk that is not highlighted on my notes is valuation can continue to go down. What if the price to free cash flow reaches 30 because you have a lot more uncertainties? 28, 27, it can happen. And I know what I will do. I will just buy more. Quite easy, right? Conclusion. FICO is quietly transitioning from a royalty-style business to a direct SaaS-like business model where it controls nearly everything, all the economics. The Jefferies report confirms the scale of this shift, roughly double the price per score and nearly double the margin. 2026 is the setup year. 2027 is when the financial impact becomes visible. My plan is simple. I buy when it goes down a little bit at $1,300 for a long-term position in what's becoming one of the most profitable data franchises in America. I think I can buy at these prices. Maybe I will greed a little bit and buy a little bit at a high level, but I will not buy right now. I want the stock price to drop a little bit more. I need more discipline in my model because I've been burned too much in the past for not having discipline. So I will just keep my discipline, wait for the price to drop. If it doesn't drop, good luck to anyone who bought the dip. If it drops, I will be here. And if it continues to drop, I will buy even more. So this was a complete video for FICO. I hope you liked it. Don't forget to leave a like, subscribe, and anything. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.